watching Bloomberg, Quint, here at the World Economic Forum's day one. The sun's out, so the mood's a little bit more cheerful than it has been in the last 24 hours. And to talk about not just the global outlook, but the India outlook as well, it's an important year for India. We have with us Puneet Dalmia of Dalmia Bharat. Puneet, thanks very much for speaking with us. Right off the bat, I could ask you about the global outlook, but we've discussed that for the last 24 hours, and the India outlook, but you're going to hide under the cover of politics. So let me straight off ask you a question that many of your investors are asking with regards to the restructuring that you have done, within your company and your group, and when you expect the listing to happen.
Sure. We started the restructuring exercise about a year ago, and I think now we are pretty much at the end of it. It was a slightly complex exercise because there were many subsidiaries, and there were two listed companies which were merging, and then there was a fresh listing which was going to happen. So I think it was a slightly more complex process, and it took longer than we expected. But now everything's behind us, it's all done and dusted. I think the listing should happen next week, so that by the time I'm in India after Davos, we'll see the new listing happen.
Okay, do you have a fixed date already, or are you still awaiting some last minute paperwork?
I think we are waiting final approvals from NSE and SEBI, but my sense is somewhere before the end of January, like 30th, 31st, or maybe slightly earlier. My min-max, if I have to give you a date, 28th is the earliest, and 31st is the latest.
Okay, that's a narrow band. We can live with that. Can you talk us through what the post-listing scenario is going to be in terms of structure and from an investor point of view?
So I think first of all, it's a very clean structure now. There's just one listed entity. I think that's the biggest transformation. And there is one subsidiary, which is 100% owned by the listed company, and then there's one more Calcom. So there's basically two subsidiaries. That's it. And all this happened because we acquired many companies over the last 5-6 years when we were expanding, and at that time the acquisition was made through acquisition of shares. So it was a structure which just evolved out of our strategy.
Sure.
And post little bit scale, we had to fold it all together. That's what we promised the market, and that's delivered now. So I think the good news is that there'll be one listed entity. Second part is that there will be synergies. I think there were a lot of extra costs which we incurred because we are managing too many entities.
Sure.
So I think there will be efficiency in terms of costs, and there will be synergies. So we are hoping that this will lead to at least 100 basis points improvement in EBITDA margins, which is pretty substantial.
Yeah.
At a scale of 10,000 crores, it will be at least 100 crores a year.
Okay, great. You spoke of your, acquisition strategy, and so let me come to that as the next question that I wanted to talk about. I'm sure from your point of view, the outcome in the Binani cement matter has been disappointing. Do you continue to hope to be able to litigate this further? And, what is the inorganic strategy for 2019-20? Do you see more such acquisition opportunities?
Look, on the Binani matter, I think the Ultratech has won the deal, and we've moved on. So there is no more uncertainty left on that account. And as far as I'm concerned, I think we tried our best. We put our best foot forward, and I think we are a little disappointed with the outcome, but we've moved on. And I think in life, I follow one philosophy that, we never lose. We either win or we learn. So I think there were a lot of learnings in this process, and that was good. But I think our focus now has shifted to managing our current expansions well. We have acquired Kalyanpur Cement, as you know, in insolvency. Murli case is going on. I hope this should get settled by end of this financial year, or maybe early FY20. So that's about 4 million tons, and we have a large expansion going on in East India, which is also likely to come on stream before the end of this calendar year. So currently we are at about 26 million tons. The capacity will go to about 37-38 million. So it's about a 50% jump in our capacity by end of this financial year. So I think we are right now focused on executing that well, and turning around the assets that we've bought as quickly as possible. So overall, balance sheet also has to remain strong, and I think we've our debt to EBITDA last year in March 18
was 3.7.
Yes, and now it's March 19 is going to be around 2.5. So I think balance sheet is improving, our cash flows are kicking in as we grow, and I think in a couple of years' time this will be a very transformed company, because as cash flows for 30 million tons start kicking in, this will be a cash generating machine. And even though at this point in time I think the cycle is a little soft, because costs have gone up, energy costs and even slag prices, etc. And we've not been able to pass on those prices to the increase in input costs to the customer, because demand was a little slow and consolidation was happening. So I think overall there is margin compression in the short term, but I'm not too much worried about it, because it's leading to consolidation, it's improving the industry structure. And in my view, we have medium-term outlook, in my view, is very, very strong, and I'm very bullish.
Okay, besides the 100 basis point improvement in EBITDA margins that you spoke of on account of the synergies, of the restructuring exercise, can you talk us through some of your, and I know we're in the middle of earnings season, so I'm not pinning you down to a particular quarter, but at least your FY20 outlook, when it comes to, are you looking at, or are you hoping to see an improvement in cement demand, hence in prices, the ability to pass on some of the higher raw material costs, what it means for utilization numbers, what is the outlook for FY20?
Look, first of all, I think, let me talk about FY19. The demand growth has been very strong, except in the last couple of months. So there has been demand growth of around 12%. And November, December was slightly muted. It was just low single digits. But my personal view is that a huge foundation has been laid in place for a strong domestic growth. And I know you said let's not talk about India and the world, but the reality is India is growing at 7.5%, and World Bank is very positive about the future outlook of India. So I think even though we see some headwinds in organized real estate, which will dampen demand, but I think it will be more than compensated by affordable housing and infrastructure build out. So there are roads being built which are made of cement, because now government is employing a life cycle costing approach to projects. Airports are being built, ports are being built, railway tracks are being built. So I think there is investment in infrastructure, even urban infrastructure. There are more than 15 cities where metros are being built, and that consumes a lot of cement, tunneling, pillars, all of that. So I think overall I'm pretty bullish about demand growth driven by infrastructure and affordable housing. Okay. And that's largely the case. Of course, there will be some other drivers in different micro markets. For example, in Andhra Pradesh, there will be construction of new capital. Right. In Northeast, there will be some, border roads, etc. So there will be, different drivers.
The pipeline looks robust enough for you to believe that demand outlook stays confident.
And even though the real estate sector will suffer from, I think, a negative outlook for a few more quarters at least, right up through financial year 20, I don't see the situation improving, because organized finance from banking is not available. Even now NBFC financing is not available to them easily. So I think real estate will struggle, but that will be more than compensated by affordable housing and infrastructure and some local demand drivers in markets. Now, as far as, so I'm pretty confident about
the demand outlook.
On the demand outlook. So I'm pretty confident that 8 to 10% demand growth, at least let's say 8% demand growth, I'm pretty confident about, continuing. On the pricing side, and I think the supply side is, there is not much supply coming in, and there is consolidation happening. So I think eventually there will be pricing power which returns to the industry. But in the short term, I think I'm a little cautious about prices. I think we are not able to pass on the cost increase in input cost to the customer, because even today at a national level we are running at 65% capacity utilization. Right. There are some markets where it is like mid 70s, there are some markets where it is like below 60, but at an average we are at 65. So there is still a little bit of market share fight in some markets, and I think Ultratech acquired some large companies of JP. It was the largest acquisition in the sector, which was running at very low utilization. Yeah. And I think they want to take it to a certain level, which JP could not. And now there's a strong owner, which will obviously try to increase its market share. So I think that part is happening. In fact, we also, like for example, acquired Kalyanpur, which was shut. We're going to, hopefully, conclude the Murli acquisition, which is also a shut plant.
Right.
So all these things, as you ramp up, there will be a little bit of market share issues in some micro markets, but eventually I think pricing power should return as demand grows and supply growth will be less than demand growth.
But not before the second half of this calendar year, you'd say?
I think that is difficult to predict, Menaka, because I think, I have been mostly wrong on the outlook for cement prices, so I cannot forecast, what will happen, and frankly, we don't even take that kind of a view when we are planning our investment strategy.
Right.
We take a much more longer term outlook. And longer term, I think, prices should, grow at a reasonably healthy pace. If I have to give you a sense, over the last 15 years, prices have grown at 5% CAGR, which is less than inflation. But over the last 5-6 years, prices have grown at only 2 to 3% CAGR. So I think in the last 5 years, the price growth has been much lower than what it has been in the last 15 years. So I think there is scope to catch up. And I'm quite hopeful that once demand growth continues its momentum and supply growth is reducing anyway, pricing power should return to the
Can you
industry.
explain this to me? It's a very interesting statistic. Why have prices been even lower than the historical average in the last 4 or 5 years? Why just 2 to 3%? Especially at a time when the industry has been doing nothing but consolidation. I mean, historically, this was such a fragmented industry, Puneet. There were people putting up 1 million tons per annum plants and then hoping to be able to spin those into acquisition targets. I remember spending a decade reporting on cement and, reporting on a bunch of Gujarat cement companies that were on the block every 3 months and then off the block every 3 months. The consolidation has still not helped bring pricing power to the market.
This is a great question. If you look at what happened in 2007, a lot of easy credit was available to companies, whether it was debt financing or even equity financing. And a lot of new entrants came into the cement sector. And I think that capacity really came on stream in 2010-11. Okay, and then it takes about 4-5 years to ramp up the plant. So there was a lot of intense competition because of these new entrants. And there were almost 17-18 new entrants which came into the industry. And I think one, the competitive intensity went up, and actually the industry deconsolidated a little bit during that time. But now, because of the insolvency law, consolidation is happening again.
Okay.
So I think partly the competitive intensity went up due to new entrants. I also feel that India is perhaps the most competitive cement market in the world. If I see the industry structure in most other economies, it's mostly under 10 players. Even in defragmented markets, under 10.
Yeah.
In India, there are still 35 to 40 companies which are competing for market share. So India is still an intensely competitive market, and I think the real consolidation and pricing power, if you compare to Western markets, it is improving, but I think it will take us a while to reach that kind of level where it's like less than 5 players who control the market. It's happened in telecom.
Yeah.
For example, after a long time and after a lot of pain,
Yeah.
So I think that any industry has to go through that kind of a cycle. It's happened in steel.
You see it happening in cement, or will it continue to be a very local market in that sense?
No, but it's already happening. You see, there is pain,
I agree.
right?
I thought it's been happening for 10 years. I mean, a lot of the new players sort of dated back to the beginning part. Sorry, the snow is slippery. Beginning part of the last, the first decade of this century, millennium. To me, between the kind of consolidation Ultratech has done, a little bit of the consolidation that happened between Gujarat Ambuja and ACC a long time ago, and and the coming together of those, we already are seeing the formation of the top 5 in this marketplace, aren't we?
Yes, I mean, top 5 still control only about 60-65% of the capacity, and there's still 1/3 of the industry which is quite fragmented. And if you see that this is a cyclical phenomena where I think when the cycle is good and people make a lot of money, it attracts many new entrants to come in. So I think we saw that in 2007, 2008, and I think that excess is getting cleaned out right now.
Okay.
However, I feel that now there are structural changes which probably will limit the new entrants to come in, and entry barriers are going up. So and most of these are driven by regulation. So if you look at limestone availability, limestone was earlier allotted. So if you had a good relationship in a state, you could get a limestone mine, and that allowed you to enter the business. But now limestone is going to be auctioned. It's just like a spectrum auction in telecom. So at the time of entry, you are competing with existing incumbents. And we've already seen this law changed in 2015. It's just been like 4 years, but we are seeing it play out. If you see the last auctions, out of the about 9 or 10 auctions, only one has been won by a new entrant. And all others have been won by incumbents. So one is the big change in regulatory landscape, that all natural resources will be auctioned, and I think that will limit new entrants. Because I think the existing incumbents will have the ability to pay much more. Okay. The second point is that this insolvency law, insolvency law has changed the entrepreneurial psyche, that if big companies or big established business houses can lose their businesses and nobody can help them, so if you are on the wrong side of the cycle, your equity will get wiped out, and you lose your business. So I think it will also not create over investment in the sector. So I think that is another big regulatory change, which in my view will limit supply. And I think the third point is that just it takes much longer in India now to build new plants. So because of the change in the land acquisition law, that's another regulatory change where you have to pay 4x for land in rural areas and 2x in urban areas. Earlier, government used to help you consolidate the land and everything. So I think now, to invest in a plant, it will take 5 years for a greenfield plant, and then to make it stabilized, ramp up and all that, is another 2-3 years. So you have to literally take a 8 to 10 year view on the cycle before you can invest. So I think these three changes, in my view, will limit the volatility in the sector and probably accelerate consolidation further. But how quickly, how long it will take, and when will pricing power return is difficult for me to predict. But clearly I can see structurally, as far as we are concerned, we see it as a more attractive sector to invest in now as compared to it was earlier.
Okay, so are there therefore then consolidation or inorganic opportunities for you that will dominate your growth strategy for the next 2 or 3 years? Or will it largely be organic once you've been able to get the existing consolidation going?
Look, we have always said this, that we will look at every single deal in the sector that happens, and we will not compromise our financial discipline to do those deals. So, for example, let's look at Binani. There was a chance for us to up the bid, but we thought that this was the best we could do to generate returns that our shareholders seek, and we walked away from increasing our bid. Similarly, in JP also, we had a opportunity to participate, although that was a much bigger transaction, and we were willing to participate only under certain conditions where our balance sheet was not stretched beyond a limit that was acceptable to us, as a board. So I would say that we will be extremely disciplined in capital allocation, and I think we will look at all opportunities that come our way and then prioritize whether a brownfield or greenfield is more attractive or acquisition is more attractive.
At this point, though, which strategy looks more attractive?
So I think it's a blend actually. If you see, we are adding 12 million tons of capacity, out of which 8 is organic and 4 is inorganic. So it's right now.
In the years to come?
I think let's see, because in my view there are not too many deals left right now, large deals. So I think in my view it is largely going to be organic, but you have to be ready. We never know with this macro uncertainties, what happens, who trips and falls down, what deals are available due to special situations. Sometimes people want to rebalance their portfolio. So I think base case, I think inorganic doesn't seem like the way forward. Base case, it looks like more organic, but again, we want to be prepared and keep some powder dry for inorganic if and when the deals show up.
Okay, quick final question. 5 years from now, 2025, who will be the top 5 players in the market?
I think 4 positions are, in my view, already taken.
Do you see that changing at all?
I think if I look at the current situation, I don't see this top 4 changing very substantially. Because Ultratech is 100 plus, that's not likely to change in a hurry. Lafarge Holcim is also, ACC Ambuja 70 plus, it's not going to change easily. Then Shree and Dalmia are somewhere in their 30s or, maybe just touching 40 in a year or 2 years' time. and then it is some companies in the teens or the just kissing 20. So I don't think the league tables are going to change very substantially, but again I would say that sometimes events happen, and it's difficult to forecast everything. So large transactions may happen in India again due to family issues, due to rebalancing of portfolios, and it's difficult to predict exactly. But I think distressed deals are more or less, done, other than some few smaller deals which are available.
All right, Puneet, we'll leave it there. Thank you so much for speaking with us.
Thank you, Menika.
Have a good rest of your
Enjoy
stay
Davos.
here in Davos. Yes.
Thank you very much.
Enjoy the sun while it's out. Thanks very much for tuning in.